Welcome everyone. Good morning. I am CS Vivek Banerjee, welcoming you to this session on mutual funds. And today, in the mutual fund section, I will be taking the various schemes and various funds covered under mutual fund before clearing a concept in this. And then I will also explain the various, you can say, advantages and disadvantages of mutual fund and other aspects of mutual funds, such as the important terms you can say used in the mutual fund, such as the net asset value, the expense ratio, the trail commission, the entry and exit load, and some contemporary subjects also, such as the side pocketing and the tracking error. So let us begin this session on mutual funds. Good morning. Good morning, everyone. So just let us look into this slide first of all and read it very carefully. What is basically a mutual fund? Mutual fund is a trust that pools together the resources of investors to make a foray into investments in the capital market, thereby making the investor to be a part owner of the assets of the mutual fund. So mutual fund is basically, you can say, a trust which pools the fund, which pools fund of various investors, one investor, two, three, four. There are hundreds and thousands of investors. So it collects money from the various investors and invest it into various avenues. It can invest in equity also. It can invest in debt also. It can invest in a combination of equity and debt. So mutual, first of all, pool money from various investors and invest it into various schemes, and whatever profit is generated, it is distributed among the mutual fund investors. So now read the second sentence of this slide. The fund is managed by a professional money manager who invests the money collected from different investors in various stocks, bonds, or other securities. As I've just mentioned, the money collected can be invested either in equity or you can say debt, or a combination of these two, or other securities according to a specific investment objective established by the fund. It depends on what is the investment objective of the fund. So basically, fund is specified that whether it is a equity fund, whether it is a debt fund. So if it is an equity fund, then it invests into equity. If it is a debt fund, then it is the pooled money is invested into debt securities. And if it is a balanced fund, then it is a combination of debt as well as equity. So let us take a practical example in this. Fine. Mutual funds. Uh, So the first point, which is that the mutual fund pooled money from the various resources. So we can say that it pooled money from, let us say, give a name to a particular mutual fund, say ABC mutual fund. And it pooled money from, say, various investors. Actually, there are hundreds and thousands of investors. But for the sake of simplicity, I'm assuming that it has collected money from actually five investors. So from five investors, it collected some money. So investor one, it collected rupees 10,000. From investor two, it collected 20,000. From investor three, it collected 30,000. From investor four, it collected 40,000. And from investor five, it collected 50,000. So total amount it collected is 30,000, 60, 1,50,000. So what is this 1,50,000? 1,50,000, it is the pooled money. Pooled money, which is collected from the investors. And then this pooled money is invested into various investment avenues. It can either be equity, debt, or a balance of equity and debt. For the sake of simplicity, I am assuming in this example that this ABC mutual fund invested in investing in the equity funds, the equity of various companies. So let us say it is investing, in the stocks of, say, company A, company B, company C, company D, and company E, investing in 5 companies. Now, whatever return is generated by these companies, either in the form of dividend or in the form of capital gain, is actually distributed. The return is distributed. Distributed to the whom? The mutual fund. Because these companies does not directly deal with the investors. So first of all, these companies A, B, C, D, whatever return is generated is passed on to the mutual fund. And then mutual fund passes the return to the, so mutual fund passes the return to the investors, to the investors. So this is basically the, you can say, the structure of the mutual fund. So what this mutual fund did, mutual fund was formed by the name of ABC Mutual Fund. It collected money from the various investors, say 1,50,000 in this case. And this pooled money, which is collected from the investors, is invested into various companies, A, B, C, D, E. Whatever return is generated is distributed to the mutual fund. Then the mutual fund passes those return to the investors. Now, let us take a practical example to understand this. Say this example of same ABC mutual fund. Now, on day one, means first day on which the investment amount, that money is collected from the mutual fund investors, and the amount which is collected, units, and cost per unit. Cost per unit. It can, cost per unit is also called as, can say, the NAV. So this is the position on, day one. So the amount, as we have assumed in the above chart also, that amount is collected from the 5 investors. Let us say investor 1, investor 2, investor 3, investor 4, and investor 5. The amount collected from first investor, as you remember, 10,000 collected. From the second investor, 20,000 is collected. From the third investor, 30,000 is collected. From the fourth investor, 40,000 is collected. From the fifth investor, 50,000 is collected. So total amount collected is 1,50,000. And cost per unit, that is NAV, is fixed at rupees 10. This figure is in rupees. So it is fixed at 10, say. So units will be the amount divided by the cost, means this 10,000 will be divided by this 10. So 10,000 divided by 10, it is, units will be 1,000. In mutual fund, actually, the term share is not used. The term units are basically used, because you can say the investors are not the shareholders of a particular company. So therefore, the mutual fund divided the whole amount into units. So it is 1,000 units in case of investor 1, 2,000 units in case of investor 3, 3,000 units in case of investor 3, and 4,000 units in case of investor 4, and 5,000 in case of investor Five. I will discussing on diversification later on. First of, let us understand this mutual fund, the structure. Now, what is the total number of units? 15,000. Okay. Now, whatever amount mutual fund is collected, the next step is to invest it into various investment opportunities. So let us take the day one itself. And it is invested into, for the sake of simplicity, let us say, assume it is invested into stocks. Stocks, days, share price, and this number of shares, and let us say it is total investment. So first stock is stock A. So mutual fund invested in stock A, stock B, stock C, stock D, and stock E. And the share prices say the stock of stock A is 10, B it is 12, C it is 15, D it is 20, and E it is 25, the share prices. And the number of shares, let us assume in case of A company, it invested 3,000 shares. And in case of B, it invested 2,500 shares. In C, it invested 2,000 shares. In D, it invested 1,500 shares. And in E, it invested 1,200 shares. So total investment is the share prices divided by the number of shares. So 3,000 multiplied by the day's share price multiplied by the number of shares. So 3,000 multiplied by 10, it is 30,000. And 12 into 2,500, it will be 30,000 in case of B also. In C also, it is 30,000, 2,000, and 30,000 in case of E also. So total amount invested 1 lakh, 1,50,000. Okay, so how we proceed? First, the same process, the mutual fund collected the money from five investors, say. The amount in units are given and unit cost is fixed at rupees 10. So this is the position in day one. And on the day one itself, for example, on this day, 21st of February 2004, on this day itself, the mutual fund invested in the stock of five companies. So company A, B, C, D, and E. And the share prices of these stocks are given in front of you. Number of shares invested also given, the number of shares which the mutual fund invested in these companies. So total investment amount comes to this 1,50,000. So whatever amount 1,50,000 is generated or pooled from the investor is invested into these companies. Now, my question is the share prices will remain same every day or it will fluctuate? The answer is obvious, it will fluctuate. It fluctuate every minute, every hour, the share prices. So share prices on day two will be different in comparison to the day one. So day two share price will be different. And on day two, then investment value. So investment can say value will also be different. Let us say the share prices, you can say, no, this is mutual fund. Just a second. So in this column, I will put the share prices. And this is the next column will be the investment value. Let us say the share prices of stock A increases from 10 to 12 on day 2. This is share prices rupees. And in case of B, the share prices, you can say decreases from this 12 to 10. Let us say in case of C, it is increases from 15 to 18. And in case of 20, it is increases from 20 to 22. And in case of E, the share prices decreases from 25 to 24. Now let us see what is the position on day 2. Share prices in case of day 1, stock A was rupees 10. Okay. And on day 2, this is day 2. On day 2, the share prices have increased from 10 to 12. So what is the position in the investment value? 3000 multiplied by 12. So it will be 36,000. And second, 2500 into 10. So it will be 25,000 in case of B. Let us calculate the share total investment value on day 2 of stock C. So it will be 2000 multiplied by 18. So it will be 36,000. And in case of D, it will be 1500 multiplied by 22. So it will come to about 33,000. And in case of E, it will be 1200 into 24. So 1200 into 24 will come to 28,800. So let us add all these figures, the total investment value on day 2. So it is 36,000 plus 25,000 plus 36,000 plus 33,000 plus 28,800. So it is basically coming to 1,58,800. The total investment value on day 2. It is 1,58,800. So you see the total investment value in 2 days increases from 1,50,000 to 1,58,800. So return on day 2. So return on day 2 will be, or you can say percentage return, 1,58,800 minus 1,50,000 divided by 1,50,000 into 100. So let us just calculate this percentage return. 1,58,000 minus 1,50,000 divided by 1,50,000. The return is coming to 5.87. I hope you are also getting this same percentage, 5.87. So this is a good enough return. A 1-day return is 5.87. And this return will be reflected on the mutual fund also. So the NAV, the cost, will also be increased by the same percentage. Okay. Because on day 2, the position in case of mutual fund will also be different, right? So this will be cost per unit on day 2. And you can say the mutual fund investment value. So mutual fund investment value. So what is the cost per unit on day 2 of the mutual fund? So it will be in proportion to the share price increase. So what is the share price increase? Percentage increase percentage increase in the value, it is 5.87. So it will be reflected on the mutual fund units also. So it will be 10 into 105.87%. So let us calculate it. Because on day one, the unit price was 10. So it is multiplied in proportion to the share value increase. So it will be 10 multiplied by 105.87%. So it actually 10.587. So now the cost per unit, or it is cost on the part of the mutual fund investor, because mutual fund investor will purchase at this unit. It is also called the NAV. NAV I will be discussing later on. So let us just understand in this case that it is cost for the mutual fund investor. 10.587. 10.587 is now the unit price. So you can say cost price for the mutual fund investor. So it is actually 10.587 on day two in case of ABC mutual fund. That is the cost per unit, 10.587. So my question is now the mutual fund investor will get the, for example, investor one wants to invest in this ABC mutual fund on day two, further units. So will he get at 10? No, the answer is obvious. The answer is no. He will get the units at 10.587, which is the unit price on day two. So this way the prices of you can mutual fund units also fluctuate. So let us see what is the investment value in this case. So we will multiply this 1000 units of collected from first investor 1000 multiplied by 10.587, which is the cost per unit on day two. So let us calculate the mutual fund investment value, the investment value of the mutual fund on day two. So investor one, it is 1000 multiplied by 10.587. So actually it's 10,587. In case of investor two, let us calculate it. 21,174 in case of investor 2. If the investor 2 now wants to purchase it, his investment value is increased from 21,174. So if the second investor wants to sell the units on day two, he can sell it at 21,174, because on day one his value was 20,000. On second day his value, and second investor's value on first day is 20,000. On second day his value is increased from 20,000 to 21,174. So if on day two he wants to sell the mutual fund units, he can do so at the higher price. Means he is getting 1,174 rupees extra, because if we deduct the 21,174 from this 20,000, we are getting 1,174 rupees profit if he wants to sell on the day two. If he wants to hold it, then it is his wishes. So let us calculate on the third investor. What is the investment value in case of day two? So it is 31,761. 31,761. Now, what is the value of the investor 4 on the day 2? It will be 40,000 multiplied by the mutual fund unit cost on day 2, that is 10.587. It is 42,348. Now calculate in case of investor 5, 50,000 investment and per unit cost 10.587. units into, it will be 52,935. So it will be 52,935. So total value, let us calculate it. Let us add all these figures. So it is coming to 158,805 investment value of the mutual fund on day two, 1,58,805. So you see that in case of shares, the stocks, the value is 1,58,800 and 805. This minor difference is basically because of some rounding off. So it is basically the same. Okay. So how this is what the mutual fund actually work. I have taken a very simple example. There are various complexities also, and there will be some practical problems later on. So if you understand this, then you will be able to you can say understand the concept later on and able to do the practical problems also. So how do we proceed? Let us say a ABC mutual fund which was formed and it collected money from various investors, five investors. So cost per unit means the unit cost at which the mutual fund investor will purchase from the ABC mutual fund. It is fixed at 10 rupees per unit. And then the total investment made, total amount collected is 1,50,000. Then this 1,50,000 is invested in the stock of five companies, A, B, C, D, E. Share prices on day one is given. We multiplied the share prices with the number of shares, we get the investment value, which is 1,58,000, which is 1,58,000. Sorry, it is 1,50,000 only. It will be 1,50,000. So this share price will not same on the second day. So on second day, the share prices fluctuated. So on the basis of the day two share prices, we multiplied the number of shares of every stock with the latest share prices. So the investment value was different and the total investment value has increased from 1,50,000 to 1,58,800. So there is an increase of 8,800 returns. So next step was we calculated the return on day two. How was the return increases? So return was coming to 5.87. So this 5.87 will also be reflected on the mutual fund, the price of the mutual fund units. So mutual fund units will also be increased by the same proportion. That is, we multiplied 10 rupees, that is the unit value on day one. This is the unit value on this day one. We multiplied it with the percentage increase, that is 105.87%. So unit cost, that is the cost at which the new mutual fund will purchase on day two, is actually 10.587 and not 10 rupees. And for the existing mutual fund investor, it is a profit because the investor one, which had invested in mutual fund, ABC mutual fund at rupees 10, he can sell it on the second day because his investment value has increased from his investment value has actually increases from this amount 10,000 to 10,587. So 5,587 rupees he can pocket on the second day. And for the new mutual fund investor who want to invest on day two, the cost is now higher. They do not have to pay 10,000. They now have to pay 10,587. So on day two, the mutual fund investment value also increases. So actually this way the mutual fund actually works. Any question on this? I will be happy to entertain. Actually, the mutual fund who are investing, actually, the mutual fund, in mutual fund, the investing is made by the companies. In companies, the mutual fund is actually investing. So mutual fund is basically the shareholder. The one who is investing in the company is the shareholder and not the ordinary investors who are actually investing in mutual funds. The cost increases means benefit to investors. Yes, the cost increases from 10 to, here see, the cost increases from rupees 10 to 10.587 on the day two. For the existing investor, it is a return because existing investor can now sell at higher value because the for investor one, the existing value is 10,000 rupees. 10,000 rupees is invested. But on the day two, his investment value has been increased from 10,000 to 10,587. So this rupees 587 is the return to the existing shareholder, that is investor number one in this case. But for new investor, it is a cost because now they have to invest at this 5.10.587 and not 10 rupees. Yes, Shruti, we will come to this because he can hold it. It is not necessary. I'm just giving an example that if the mutual fund investor wants to sell on day two, then what will be his position? He can hold for 30 days also. He can hold for a long period also. And we will see that there are certain types of mutual fund in which the mutual fund investor, there is a fixed maturity period. And in case of some mutual fund, there is no maturity period. They can buy the mutual fund at any time and they can sell the mutual fund at any point of time. So this we'll see when we proceed with the further slides. NAV, Satish, NAV will come to later when it is thus, this example has just been given to give you a conceptual clarity of how mutual fund works. The net asset value will come later to on because at this stage you might get confused. So we will proceed step by step and we will come to NAV also and we will solve practical questions on NAV. Up to this, any other question from you? Okay. So I'll proceed further. I hope this slide is now clear to you. If you want to read it, you can read it once again. And if any questions, you may proceed. Now come to the second aspect of the mutual fund, that is evolution of the Indian mutual fund industry. The Indian mutual fund industry, students have actually proceeded, or you can say, gone forward very slowly. In 1964, Unit Trust of India came out with a mutual fund scheme. That was the first mutual fund scheme in India. It was called US 64 or Unit Scheme 64. It is the Unit 64, or it is also called as US. It is also called as US 64. And that was the first mutual fund scheme. And this continued for about from 1964 to 1987. So from 1964 to 1987, there was only one mutual fund scheme, which is US 64 or Unit Scheme 64. Then from 1987, some public sector have been allowed to venture into mutual fund. Besides UTI, certain other sectors were also got entry, such as public sector banks have got entry. The SBI, PNB, Canara Bank also entered into the mutual fund industry. Some public sector banks, and then certain Life Insurance Corporation of India has also ventured into mutual fund. Then General Insurance Corporation of India has also ventured into mutual fund. So you can see from 1964 to 1993, there was a monopoly of public sector units in mutual funds. Now, what happened later on? So now came the third phase, that is from 1993 to 2003. After this liberalization, privatization, and the globalization, the mutual fund industry was open to the private sector. So private sectors also came, And from there onwards, actually the growth of mutual fund took place. So various private sector came, and then a very important development took place in 1996 when the mutual fund was actually regulated by SEBI, the market regulator, Securities Exchange Board of India. So SEBI came out with mutual fund regulations 1996. So from 1996 onwards, the mutual fund industry was regulated and monitored by the market regulator, Securities Exchange Board of India. Then came the fourth phase, that is from February 2003 to April 2014. In this case, one important development took place. That is, the unit trust of India was bifurcated into two parts. So one part was managing the old US 64 scheme, that is Unit 64 scheme, and second was established as the UTI mutual fund. And UTI mutual fund was actually promoted by various public sector units. For example, State Bank of India, Punjab National Bank, Bank of Baroda, and LIC. So unit trust was divided into two parts. Can say, and the important development which take place is repeal of the Unit Trust of India Act. That Unit of Trust of India Act was actually repealed, removed, and UTY was bifurcated into two parts. So one part was managing the US 64 scheme, and other was established as UTI mutual fund. Other was established as a UTI mutual fund, which was promoted by various, you can say, public sector units. So it was actually promoted by public sector banks such as SBI, and the list is given, that is SBI, PNB, BOB, and LIC, that is State Bank of India, Punjab National Bank, Bank of Baroda, and the Life Insurance Corporation of India. Now, the actual growth of the mutual fund industries exponentially took place from May 2014 onwards. That since May 2014, the exponential growth of mutual fund industry actually took place. So let us read this slide. To re-energize the Indian mutual fund industry and increase in its penetration, SEBI introduced several measures from 2014 onwards, and it is still using various measures to actually give a boost to the mutual fund industry and make it more transparent to the investors also. And with the formation of new government, let us read the second sentence, that with formation of new government and successive measures taken in reversion of negative trend, the situation improved significantly in the mutual fund industry. And hence, since 2014, May 2014, in fact, the industry has witnessed steady inflow and increase in number of investors as well as AUM. AUM is basically the assets under the management. Or you can say whatever investment, what is pooled money the mutual fund industry is carrying is actually the assets under management, because whatever investment is taking place by the has taken place by mutual fund industry is its assets. So it is assets, AUM is assets under management. Now it is estimating that the mutual fund industry is currently going forward, and it is estimating to be about, you can say, 52 53 lakh crores. The present, the amount is, you can say, rupees 53 lakh crore, the assets under management presently. Say this is the present figure. Okay, now let us come to the classification of mutual funds. Mutual funds, there are three different classification of mutual funds. functional classification, portfolio classification, and third is ownership classification. We will take one by one all these. First of all, functional classification, and in functional classifications, just give me a second. Let's see if any query comes. Yes, investment in mutual fund and investment in SIP is actually the same. You can say investment in mutual fund is a broader concept, and investment in SIP. I will come to SIP, that is systematic investment plan. It is part of the mutual fund, means fixed amount is actually invested every month into the mutual fund. If you're investing in a mutual fund, it means you're investing a lump sum amount. So it can either be a lump sum amount or it can either be an installment. So if the investment in mutual fund is an installment, it is basically SIP or systematic investment plan. Now come to functional classification of mutual funds. So it is divided into two, open-ended fund and closed-ended fund. I will take some time to explain this because this is the basic crux of the mutual fund, that is open-ended funds and closed-ended funds. Open-ended funds, closed-ended funds. Basically, open-ended funds, in this, if an investor, for example, you or me, as is investing in open-ended funds, so an investor can buy and sell in these open-ended funds at any time. Means buy and sell at any time. Or you can say entry or exit at any time. So there is a flexibility in case of open-ended funds. What about the closed-ended funds? As the language says close, it means it is only available for purchase during the period when the mutual fund is launched. It is also called the NFO of the mutual fund. Mutual fund is launched. Though, so closed-ended funds can be purchased only during a particular period. So can be bought only during the NFO period. NFO is basically new fund offer. New fund offer. It is just like a IPO, that is initial public offer in case of shares. So the term NFO, a new fund offer, is used in case of mutual funds. So with, if any new mutual fund is launched, it is available for investing by the public, and the period is generally from 15 to 30 days. So during this 15 to 30 days, the investor, if it wants to invest in a closed-ended fund, he has to invest during that period only. It means between 15 to 20 days. And after that, it is closed. So it cannot purchase the unit. But is there a solution? The answer is yes. It can purchase later on because these closed-ended funds are listed in stock exchange. These closed-ended funds are listed in stock exchange. Listed in stock exchange, it means an investor, for example, I have not participated in the new fund offer, and you have actually purchased the closed-ended fund during this particular period, during 15 to 30 days period. I want to purchase it now after this new fund offer closes. So I can purchase it from you in the stock exchange. So just like shares, when can shares can be purchased from one person to another person or sold from one person to another person. In this way, the closed-ended funds can also be purchased from an existing investor. So it can be purchased from an existing investor. Can be purchased from an existing investor. So this is basically, you can say, the concept of the closed-ended funds. So what are open-ended funds? Open-ended funds can be bought and sold at any time. And it can also be, new fund offer is there in case of both open-ended fund as well as closed-ended fund. But the difference is that the closed-ended fund can be purchased only during a particular period, during those 15 to 30 days period. And it is listed in the stock exchange. So if a particular investor who missed the chance to purchase a closed-ended fund which is launched during that new fund offer period, it can purchase it later on from the existing investor. But the problem in closed-ended fund, which is the sometimes the closed-ended fund investors or closed-ended fund actually encounter, is the liquidity problem. Because it is not frequently traded, that is closed-ended fund, therefore it is sometimes very difficult to sell the closed-ended fund in the you can say the stock market, the stock exchange. So these are, you can say, the open-ended funds and the closed-ended funds. And I will just give you an example of some of the, I hope this is visible in front of you. These are some of the open-ended funds, you can say. I have, this is the AMFI side, Association of Mutual Funds side. And these are some of the open-ended funds. And you can see the closed-ended funds also. So you can differentiate it between these two. This closed-ended fund, unfortunately, the data is not available. But so this is the open-ended fund in case of Axis Fund. So these are open-ended funds. You can see, one can see the performance of the open-ended fund as well as closed-ended fund in by visiting the, you can say, AMFI site, that is Association of Mutual Fund, the site of Association of Mutual Fund, which is actually the, you can say, facilitator of mutual funds. So this is basically, one can find the details regarding the open-ended funds or closed-ended funds or any details regarding mutual fund in Association of Mutual Funds website. In short, it is also called the AMFI. Yes, mutual fund can also invest in derivatives also. These are sometimes the arbitrage fund and hedge funds. The mutual fund invested in can invest in those funds also. Okay. Now we have first taken functional classification. Any question on open-ended fund and closed-ended funds? Yes, very correct, Kirti. Actually, mutual fund investors are unit holders and they are not actually shareholders, and only prices of units depend on the prices of share. There are various other factors also which actually influences the, you can say, unit value of the mutual fund, which we'll see later on also, besides the share prices. It is regulated by SEBI, but you can say Association of Mutual Fund is not a regulator. It is also, it is a facilitator. So it is to help or facilitate the investor. So every information one can get regarding the mutual fund can get from the Association of Mutual Fund site. So Association of Mutual Fund basically works as a facilitator. Yes, open-ended funds and closed-ended fund differentiation. Yes, on the basis of buy and sell, not only sell. Open-ended funds can be bought, purchased, and sold at any time. And closed-ended funds can be bought during a particular period of time only. And it has a fixed maturity period also. It has a fixed you can say, just give me a second. It has a one thing I have told you also, I will mention it here also. It can be, it has a closed-ended fund has a, it has a fixed maturity period. Closed-ended funds at a fixed maturity period. So it can be sold during that period only. For example, 3 years, 5 years, say. Okay. Okay. Shall I proceed further now? Now you have understood functional classification, open-ended fund, closed-ended funds. Now let us read this slide briefly because I have already explained to you this. You can look into it briefly. Okay. Now let us proceed further. Portfolio classification. According to portfolio, the funds are divided into three parts: equity funds, debt funds, and some special funds. Let us first take the equity funds. Equity fund first, growth funds. So growth funds from the, you can say, from the terminology, you can make out that the purpose is to uh, invest in those companies which are growth oriented and which can give higher return to the investors in long term. So basically, they seek to provide, basic purpose is to invest in those companies. Growth oriented funds are basically for the purpose of those investors who seek to provide long term capital appreciation to the investors and are best to long term investor is growth oriented funds. Another part of the equity funds are aggressive funds. Aggressive funds, as the name suggests, they actually made investment in those companies which are risky but can generate higher income in the future. Basically risky but can generate higher income in the future. So those companies can be startup companies which have come out in IPOs, speculative shares. So basically, aggressive funds invest in the, you can say, startups, IPOs, and the speculative shares. So this is basically for the aggressive funds are basically for the risky investors who are willing to take more risk. Now come to income funds. So income funds basically invest in those companies which the mutual funds think that they are less risky. So basically invest in those companies which pay cash dividends, which pay higher dividends, and and also in high yield money market instruments also. So money market instruments, I will explain it later also. That is, these are basically instruments for 1 year. So investment is basically for a short period of time. And these money market instruments are considered as less risky also because they are for a very short period of time. Speculation is less in case of those, and basically in case of government securities also. So these are less risky money market instrument, and also the good large companies which regularly pay dividend are also considered to be less risky. So the purpose of income funds is to invest in those instruments, either money market instruments or in companies which are paying high dividends regularly, is to reduce the risk of the investors. So these are for risk averse investors or for those investors who are not willing to take more risk. Now come to portfolio classification according to debt funds. Basically, debt funds are of two types: bond funds, gilt funds. So bond fund basically invest in fixed income securities, for example, government bonds, corporate debentures, convertible debentures, money market, as I have just mentioned. Gilt funds are basically invested in government securities, that is the government, and these are considered to be the safest of all the instruments. Government securities. These are considered to be safest form of investment. Therefore, these are basically least risk. You can say, I will not use the term less, it is actually least risky. And say least risky. And therefore, return is, if risk is less, then return will also be less. So return is less in case of government securities. Now come to special funds. What special funds are of following types: index funds, international funds, and the offshore funds. Now, I will take some time to explain this concept index fund. Let us read this the slide on index fund. They are passive funds which invest in market indexes like Nifty and Sensex. So, first important point is index fund is that these are passive. And second point is that invest in market indexes. Basically, invest in now market indexes such as Nifty and Sensex. And they are low cost and invested with a long term perspective. Let us understand these points. Index funds. So, index funds are basically passive. Why this is called passive? This is called passive because the mutual fund managers do not directly invest, do not actively participate in this. They are merely act as a they merely act as passively. They simply invest in indexes. Let us say Nifty. Let us say Nifty 50. So there will be a passive fund by the name, let us say, Nifty 50 Index Fund by the name. So if the name of a mutual fund is Nifty 50 Index Fund, so you can make out that whatever amount you have invested has been invested into the Nifty 50. So the work of the mutual fund manager will be less. They will not have to do proper research from time to time, or they do not have to reject, or you can say make changes in the portfolio from time to time, because they simply invest in whatever shares are there in the Nifty 50. Okay. In comparison to active funds, other besides index funds, other are active funds. In active funds, the mutual fund managers actively participate. Actively participate. In this, the mutual fund managers remain passive. Remain passive means why passive? Because they simply invest in those shares which are there in Nifty 50 or any other index, Sensex, or you can say Nifty Pharma, you can say Nifty Metal. So they basically invest in the indexes. So whatever shares are there in the Nifty 50 or any other indexes, they will generate the return, and mutual fund manager will be happy to pass on those return to the investors. So basically, that is the difference between the passive funds and the active funds. So index funds are basically passive funds. Why passive funds? Because the mutual fund investors invest those shares in the indexes. So whatever shares are there in indexes will be in the portfolio of the mutual fund managers also, or mutual fund manager of the index fund. Another thing which I mentioned is passive. They are invested in market indexes, and the third point is they are low cost fund. They are low because the expenses are low. Expenses are low in case of index funds. What is the reason why expenses are low in case of index funds? The reason is that they are actually passive. The reason is the passiveness, because the mutual fund investor do not have to make constant research all the time, and they will not have to be actively involved all the time. And You can say research and development expenses and consultancy, you can say charges on the part of the mutual fund is less. That is why the expenses are low. Since the expenses are low, then it will be able to, it is beneficial for the investors also. So one part is that expenses are low in case of index funds, and they invested for a relatively longer time. So horizon in case of is basically long term horizon. Long term, you can say investment horizon in case of index funds. Okay. Now come to international funds and offshore funds. So I will explain to you. You please read this slide. That international funds is a mutual fund located in India, which is located in India to raise money in India for investing globally. And offshore funds and mutual funds which are located in India to raise money globally for investing in India. So the difference between these two, that is international funds and the offshore funds, will be clear with the help of the following. Let me just try to explain this so that you can, this is the difference is clear between these two, the investment funds and offshore funds, the international funds and offshore funds. International funds, offshore funds. So international funds are basically located in India, and these offshore funds are also located in India. Now come to the second point, which is the, I think, the main point which differentiate between these two. Money is raised in India. Money is raised in India. And in this case, money is raised abroad. Money is raised abroad, outside India. Money raised outside India. And the third point is that international funds and offshore funds invest outside India, invest outside India, and offshore funds invest in India. I hope now the difference is clear. You can see both these international funds, offshore funds, international funds located in India, offshore funds also located in India. International funds, money is raised in India, and offshore fund, money raised abroad. Money is raised abroad. International funds invest outside India. Okay. And offshore fund invest in India. So that is basically the difference between these two funds. So these are special funds, index funds, international funds, offshore funds. I hope it is clear to you. We'll proceed further. Now come to sector funds. Sector fund, this is also important, students. Actually, sector funds invest their entire fund in a particular sector. You can say a particular industry, you can say. For example, the example is given in front of you in the slide itself, that is utility fund for utility industry like power, gas, public works. And not only you can restrict it to this, it can be a steel sector, it can be cement sector, it can be auto sector, it can be pharma sector, okay, etc. So it can be in any sector. Now the question is whether sector funds or sectoral funds are risky. The answer is yes, because the mutual fund is invested in a particular sector. For example, it is invested in a steel sector. And then there is a sudden jolt in steel industry and the steel prices came down. So in this case, the mutual fund will also suffer loss and the mutual fund investor will also suffer loss. So obviously there will be a proper research and development on the part of the mutual fund, but still investing in a particular sector is basically considered to be risky. But if the mutual fund industry or particular mutual fund is actually confident about investing in a particular sector, it can invest into it. And it also depends upon basically the psychology of the investor also, that whether he wants to take more risk. If he wants to take more risk, he will get more return. And if he wants to play safe, then his return will be less. Now come to money market return, money market fund. This is actually, you can say, the opposite of sectoral fund, because money market mutual funds are considered to be very safe in comparatively very safe instruments. Now, what are these features? The objective is preservation of capital, easy liquidity. It can be, you can say, uh, purchased anytime, it can be sold anytime. So money market mutual funds are easy liquidity and it is for a very short period of time, basically 3 to 6 months, maximum 1 year. That is money market mutual fund. And moderate income. The income is moderate in case of money market mutual fund because it is for a money market mutual funds are basically for a short time, short period of time. Less risky. Less risky, therefore less return. And the instrument which are basically used in money market are basically commercial papers, certificate of deposits, treasury bills, and government securities. So bulk of the money market funds actually comprises of treasury bills, which are actually the government securities, which the which are basically, you can say, government securities issued by RBI on behalf of the government. So these are basically safest among all the instruments, this money market funds. And since it is considered to be safest, the return is also less. But the advantage is that it, besides being safe, it is the liquidity is also good because the investor can, you can say, encash the uh, money in a very short period of time. So it is basically 3 to 6 months and it can go to also 1 year also. So these are basically money market mutual funds. And these are also called liquid funds. You have heard the term the liquid funds and ultra, you can say, liquid funds. So these are basically come under the money market mutual funds. If you you can explore the international and offshore funds. You can Google it, and there are various international and offshore funds will come under it. So if you mutual fund, in case of international mutual funds and in case of offshore funds, so example, various companies are actually investing into it. So you will get the result. You just have to Google it. Now come under fund of funds. Fund of funds, as the name suggests, are schemes which invest in other mutual fund schemes. Means one mutual fund scheme is invested into the other mutual fund scheme. You understand? The fund of fund means one mutual fund scheme is investing into the another mutual fund scheme. That is called what is called as fund of funds. Okay. Now come to capital protection oriented fund. Capital protection, as the name suggests, so the basic objective is to protect the capital of the investors. Capital protection. So I will take some time to explain this, the capital protection and also gold fund also. Capital protection oriented fund. Okay. So these are primarily, the purpose is to protect capital. Purpose is to protect the capital, means whatever amount has been invested into the mutual fund. Therefore, Predominantly debt. Predominantly in debt means heavy amount is invested in debt because the purpose is to protect the capital, and only a small amount, only small portion in equity. Only small portion in equity. And these capital oriented protection fund is basically a close ended fund, basically a close ended fund. Therefore, it is actually also listed in the stock exchange also. So basically, capital protection oriented fund, the purpose is to protect the capital. Since the purpose is to protect the capital, it's predominantly invest in debt. Only a small portion is invested into the equity. And these are close-ended funds, and therefore it is listed in the stock exchange also. Now come to gold funds. So gold funds basically invest in not in physical goods. They basically predominantly invest in gold mining companies. Gold mining companies. And whatever return is generated is actually passes on to the investors. Yes, you can say that, Nirmala, that gilt funds are basically separate, but it can be considered as a part of money market mutual funds also. These are used as separately also, or it can be used as a part of, you can say, money market, because treasury bills are part of the money market, and treasury bills are basically government securities, because treasury bills are issued by the government of India issued by the RBI basically on behalf of the government of India. But in money market, there are several other instruments also. For example, you can say commercial paper, commercial bill, certificate of deposits. So these are not basically gilt funds. So gilt funds, you can say, can be compared with the treasury bills. So you can say that gilt funds are a part of money market mutual funds. Okay. Now come to another concept in mutual fund and a portfolio classification. That is quant funds. Just read this slide carefully, and you will be able to understand what quant funds is. So, quant funds, basically in quant funds, the basic purpose of stock selection and investment decisions are based on uh, statistics and mathematical models. Okay. So this point is important, this stock selection and investment decisions. The stock selection investment decisions are based on certain parameters by using statistics or mathematical based models. Since statistics or mathematical based models are used in quant funds, these are the programs are automated and decision is taken on the basis of whatever data which has been feeded earlier. So in this case, the role of the fund manager is not much. So in this case, you can say the fund manager is more or less passive in this case. The role is passive. So in most of the quant funds, the expenses are less because in this case, because of the passiveness of the mutual fund manager. Why the mutual fund manager is passive? Because the decision is already taken by using the statistics or mathematical models. Okay, and now what are the, you can say, what are the advantages? You can say advantages of investing in a quant fund. What are the advantages if one wants to invest in a quant fund? It actually removes, first advantage is that it removes human bias. It removes human bias And second point is that expense ratio is low. As I've just mentioned, expense ratio is low, or you can say expenses are low because of the passiveness of the quant fund manager. So it removes human bias as objectivity. Expense ratio is low in case of quant fund. But disadvantage is that it is based on historical data. It is based on historical data. So it is not 100% foolproof. This quant fund investment in quant fund is not 100% foolproof. There are pros and cons in quant funds. Now come to ownership classification. Funds are classified into public sector mutual funds, private sector mutual funds, and the foreign mutual funds. So public sector mutual funds are sponsored by a company of the public sector. There are certain public sector mutual funds also, for example, promoted by SBI, State Bank of India, promoted by PNB, promoted by Canara Bank, promoted by BOB, that is Bank of Baroda, etc. So there are various public sector mutual funds also. There are various mutual funds in private sector also. These are public sector mutual funds. And there are various in private sector mutual funds also. In private sector mutual funds, there is, you can say, Aditya Birla Mutual Fund, Aditya Birla Mutual Fund. Then there is Axis Mutual Fund, HDFC Mutual Fund, ICICI, etc., etc. There are various players in the, you can say, private sector also. Foreign mutual funds, these are less, but there are now various foreign mutual funds also. For example, Franklin Templeton. So, funds are classified into these parts also, public sector. So, it is up to the investor whether it wants to invest in the public sector mutual fund or private sector mutual fund or a foreign mutual fund. Now, before going into the break, I will discuss a very important concept in mutual funds, direct plan and the regular plan. Let us understand this first. What is a direct plan and what is a regular plan? A direct plan and a regular plan. Direct plan, as you can see from the word is direct, means you can directly invest in a particular mutual fund. It means investor can directly invest in a mutual fund. Say, pick a mutual fund, Axis Mutual Fund. If an investor wants to invest in an Axis Mutual Fund, so he can or she can go directly to the website of the Axis Mutual Fund and invest there. And in case of, but what are the advantages? What are the advantages? Advantage is that the distributor expenses will not be there. So expenses will be low. If expenses will be low, then NAV will be high. NAV is just like you can say unit cost or the price, as I have explained in the first example, that it is the price at which the existing investors can sell. If the NAV can be high, so existing investor can sell at a higher price and gain a good return or a capital gain on this. Now, in case of regular plan, investor invest in a mutual fund through a distributor. through a distributor. These distributors actually have to be registered themselves with the Association of Mutual Fund, which I have just mentioned, AMFI. The reason is that if one wants to, you can say, check the genuineness of a particular distributor, it can go to the AMFI site and check that whether a particular distributor is registered with AMFI or Association of Mutual Funds or not. Then, but and it invests in Axis Mutual Fund, but through the distributor. But what is the difference between this direct plan and regular plan? If I wants to go the purchase the Axis Mutual Fund under direct plan, and my friend wants to purchase the Axis Mutual Fund under regular plan, so what will be the difference? Who will be more benefited on this? The benefit lies in the expense ratio. That is, expenses will be high if one invests through the regular plan. Expenses will be high. Why? What is the reason why expenses will be high? Because the mutual fund have to pay to the distributors also. Mutual fund have to pay fees, or you can say commission, to distributor. Which is also called a term is used, which is also called a trail commission. In this case, there will be no distributor expenses. Mutual fund is not, if one opts for a regular direct plan, then there will be no distributor expenses because the mutual fund investor is directly investing into it. It goes to the website of the Axis Mutual Fund and directly invested into the mutual funds of Axis Mutual Fund. But this will be beneficial only for those investors who have sufficient time to research and analyze. Because if one is directly investing, then one has to be conversant with what mutual funds are good, beneficial, and whether to invest in equity, whether to invest in a debt mutual fund, whether to invest in a balanced mutual fund, which will be a balance of debt and equity, how much to invest, whether invest in a large cap, mid cap, small cap companies. So all these decisions has to be taken on the basis of proper research and analysis. So if an investor does not have the time to do all this research and analysis, he can directly purchase through with the help of the distributor. So, but in this case, there will be a cost on this because there are various distributors of, you can say, Access Mutual Fund, you can established in various length and breadths of the country. So for this, the mutual fund has pay commission to these distributors to actually bring in more clients. So one approaches a distributor who has to be registered with the AMFI, Association of Mutual Fund. Then certain fees has to be paid by the mutual fund to the distributor, which is called a trail commission. And this expenses will not be given by the mutual fund out of its pocket. It will be deducted from the return of the investor. So that is why expenses will be high and return will be less. So NAV will be comparatively less. NAV in case of regular plan will be comparatively less. Okay, so this is what. Yes, Suraj, you can say there is no broker involved. Broker, I will use the term distributor also. There is no distributor involved in case of a direct plan. So, this is basically the concept of direct and plan and regular plan. Keep your questions ready. If you still have any doubt between direct plan and regular plan, keep your queries ready. And if you have any other query of the topics all which have been already discussed, we will take a short break about 10 to 15 minutes and we will come back after that. So, thank you. Welcome back. I was discussing this regular plan and the direct plan. Just give me a second. Yeah. So, what is this difference between direct plan and regular plan? In direct plan, the investor can directly invest in a mutual fund, whereas case of a regular plan, the investor invests through a distributor, and that distributor have to be registered with a association of mutual funds. That is the in short form we call it MF. Let us say we, as an investor, wants to invest in a Axis Mutual Fund direct plan, and another one wants to invest in Axis Mutual Fund regular plan. So what will be the difference? The difference lies in the expenses. So expenses will be low in case of direct plan, and expenses will be higher in case of a regular plan. What is the reason? The reason is that the mutual fund have to pay certain commission to the distributor, which is also called a trail commission. So this commission will not be paid by the mutual fund from his own pocket. It will be collected from the investors. So that is a burden on the part of the investors. So since the expenses will be high in regular plan, the NAV will be less. Since in direct plan, the expenses will be low because an investor is investing in a mutual fund directly without the intervention of the distributor, the expenses will be low and thus the NAV will be high. So that is basically the basic difference between direct plan and a regular plan. So I hope it is clear to you. Let us move forward. Now come to types of schemes. Balance fund. Balance fund I was mentioning during my lecture also in initial slides. Balance funds means balance of equity and debt. So any investor who wants to take some amount of risk, but but he do not wants to take too much more risk, and he wants also satisfied with some less amount of return because he wants to play safe. So in this case, the investor basically invests in a balance fund. So it is actually balance fund is, you can say, a balance of debt and equity. Actually, some major portion is in equity. Most of the mutual funds, I will not say all of the mutual fund which are issuing balance funds. Basically, it is a 60-40 ratio most of the time, I would say. So 60% in case of equity, or you can say 40% in case of debt. So balance fund, what is the idea of a balance fund? The idea of a balance fund is to cater to those investors who want to take some amount of risk and they are satisfied with a lesser amount of return in comparison to equity funds. Now come to the second point, which is equity diversified funds. Equity diversified fund is a fund that contains a wide array of stock. So diversification is high. For example, it invested in 40, 50, 60 shares of 60, 40, 50, 60 companies. So thus this high level of diversification actually reduces the risk. This high level of diversification reduces the amount of risk. But in reducing the risk, the return is also less. The return is also less. Because too much diversification leads to less return, because some companies may not be able to gain higher profits. Some companies are losing, and some of the companies are giving a good return. So on account of a total mix, we can say that the return is not that high. If the diversification is more or less, you can say less in comparison, then the return is high. So very high diversification leads to less return, comparatively less return. Now come to another important concept, which is flexi cap and multi cap. So I will take some time to explain this flexi cap and multi cap. Flexi cap and multi cap. Flexi cap fund and multi cap fund. In flexi cap, as the name suggests, that is flexibility. Flexibility as to what? Flexibility as to capping. First of all, it is very important to understand that there are three types of, you can say, capping. First is large cap companies. Large cap companies means top 100 companies. First 100 companies on the basis of market capitalization, on the basis of market cap. That is large cap companies. Second comes is mid cap companies. Mid cap companies. So mid cap companies are between 101 to 250. Next 101 to 250 companies. That is called mid cap companies. And next comes the small cap companies. Small cap companies means 251 onwards. So top 100 companies are called large cap companies. These companies are considered to be, you can say, safest among all the companies because of the compliances and because they are in the business for a long period of time. Yes, Suraj, market cap means market price per share, current market price per share multiplied by the number of outstanding shares. So market cap, that is market capitalization, is equal to current market price per share, current market price per share into outstanding number of shares. Or you can say the more precise language I will use into number of outstanding shares, you can say number of shares. That is the market capitalization. So on the basis of market capitalization, top 100 companies are considered large cap. From 101 to 250, it is considered as mid cap. And from 251 onwards, it is called small cap. So large cap companies are considered to be safer. And mid cap companies next safer, and small cap companies, according to some investors, not considered as very safe, the least safer, you can say. So in flexi cap, what I was telling, that flexi cap and multi cap. So in flexi cap, there is flexibility as to capping. There is flexibility as to capping. Means it is up to the mutual fund manager how much he invested in a large cap, how much he invested in mid cap, how much he invested in a small cap. So it is up to the mutual fund manager. But it is not that he will invest too much amount in small cap and put the investor into risk. The mutual fund manager also have to be vigilant on this. Therefore, practically, in most of the cases in flexi cap, majority of the funds are invested into the large cap in order to be safe. Some portion is in mid cap and some smaller amount is in small cap. This is what happens in case of flexi cap. So flexibility as to capping means there is no restriction, there is no burden on the part of the mutual fund manager how much to invest in a large cap, mid cap, and a small cap. But there is one, you can say, foundation on the mutual fund manager, that is at least 65% of the investment must be in equity, must be in equity shares, must be in equity shares. Okay. Otherwise, there is no such restriction. And what about multi-cap? In case of multi-cap, as the name suggests, there is capping. That is, in large cap, at least 25% of the total investable fund should be invested. In mid cap, at least 25%. And in small cap, at least 25%. So by default, 75% should be in equity. But my question is, which one is riskier? That is, multi-cap is more risky or flexi-cap is more risky? On the basis of capping and this multi-cap seems to be riskier. The reason is that 25% must be in small cap and 25% must be in small cap and 25% must be in mid cap. So it is generally considered to be comparatively riskier in relation to flexi cap. So this is what is flexi cap and multi cap is, and that is the difference between these two, flexi cap and multi cap. Now come to contra fund. So contra fund basically invest, just read the slide carefully, contra fund. A contra fund invest in those out of favor companies that have unrecognized value. So out of favor companies means those companies which are not favorite on the part of the investors. The basic, you can say, motive behind contra fund investment is to pick those companies which are not at present doing very well, but which have the potential to do well in future. So the contra fund manager pick those companies which have potential for high growth in future. So the purpose is to invest at a low price today and encash it when the prices will be higher, because growth opportunities are higher in future. The mutual fund managers think that the fund will do well, so invest in such companies at present at low value and then encash it when the actually the NAV or the prices increases in future. Now come to equity diversified funds, dividend yield funds. Dividend yield fund invest in shares of companies having high dividend yields. So basically, as the name suggests, it's invest in those companies which are generally pay high dividends. So it is more suitable for the investor who wants to play safe or who wants to take less risk. Now come to ELSS. This is one of the, again, most popular schemes of the mutual fund, equity linked savings schemes. ELSS is one of the options for investors to save taxes under 80C of the Income Tax Act. And they offer perfect way to participate in the growth of the capital market, having a lock-in period of 3 years. So I will take some time to explain this ELSS. This is equity linked savings scheme. In equity linked savings scheme, it is basically a open-ended fund. It is basically a open-ended fund. In spite of the fact that there is a lock-in period of 3 years. Lock-in period of 3 years. Lock-in period of 3 years means if one invests in an equity-linked savings scheme, one cannot sell it for a period of 3 years. For example, one invests in the month of February 2004. So it cannot sell it up to January 2027. So there is a lock-in period of 3 years. And after that, it can sell it. So it is an open-ended fund, this equity-linked savings scheme. And one of the main features of investing it, or you can say the main purpose of investing in a equity-linked savings scheme, is to save taxes, save taxes under 80C of Income Tax Act, under 80C of Income Tax Act. So basically, the investor can save up to 1.5 lakh per year under 80C of the Income Tax Act. So basically, the purpose of the investment in the equity linked savings scheme is to save taxes, which is available as per 1.5 lakh per year under 80C of the Income Tax Act. There is a lock-in period of 3 years in which the investor cannot invest. It is basically open-ended fund. Basically, investments, majority of the investment is in equity, as the name suggests, equity linked savings scheme. So this is what about equity linked saving scheme. Now come to thematic funds. One of the student was asking about it. Now I will come to thematic funds, and I will differentiate it between the sectoral fund, that so that these two concepts are clear to you. Thematic funds and sector funds are sectoral funds. So just let us read it. You will be able to, and then I will explain it. A thematic fund focuses on trends that are likely to result in the outperformance by certain sectors or companies. Theme could be anywhere, anything, means multi-sector, international exposure, commodity exposure, etc. So unlike a sector fund, theme funds have a broader outlook. So thematic funds are broader and sectoral funds are, you can say, a narrower concept. Come to thematic funds. So thematic funds invest in a theme. And what could be a theme? Theme can be a theme can be a for example, ESG. What is ESG? ESG is basically environment, social, and governance. Now it is mandatory for some companies actually to comply with ESG. So say a mutual fund's theme is ESG and it wants to invest, excuse me, it wants to invest in those companies which are actually doing, we can say, comparatively well in ESG. Invest in companies having a good ESG performance. So it will cover a very large number of companies. It can cover a large number of sectors. For example, it can cover sectors which are performing good, well in ESG. It can cover financial sector, pharma, technology, steel, cement, etc. So if a mutual fund come out with a ESG uh, fund, that is a thematic ESG fund, then as an investor, you know that it invests in those companies which have a good ESG performance, covering various sectors: financial sector, pharma sector, technology sector, steel sector, cement sector, various companies. Another example I can take is another example is say infrastructure. So in infrastructure, what will be covered? Infrastructure, cement will be covered, steel will be covered, uh, construction industry will be covered. So if you can say a mutual fund comes with a thematic fund, which is infrastructure based, then as an investor, you know that this fund will be investing cement companies, steel companies, construction companies. So you can say the outlook is broader. So इसमें जो दायरा बढ़ जाता है, outlook is broader in comparison to steel, in comparison to sectoral funds. Sectoral funds concentrate on a particular sector only, either steel or cement or construction. But in thematic, it is a combination of all three. So risk is lower in case of a thematic funds. Risk is still high in comparison to other funds, but it is risk is lower in comparison to sectoral funds, and the prospect of return is also high. There is one query. Investment in AI, climate finance, example of thematic investment, you can say that in future some funds may be companies who are some funds in future may come which focus theme is, you can say AI or theme is climate. So it is possible that such funds may come. Now come to arbitrage funds. So arbitrage fund seeks to capitalize on the price differential between the spot and the future market. Someone was asking that whether it is the investment in futures can take place also. Yes, the investment can be taken place through the arbitrage funds. So these funds are the ideal for investors who want to benefit from high volatility by taking minimum risk. Then case of hedge funds also. So these funds are aggressive funds that take advantage of derivative positions in both domestic and international market. So hedge funds are also considered to be safer, and in which the if it is safer, then the risk is also less. Now come to cash funds. What a cash fund? Cash fund is an open-ended liquid scheme that aims to generate returns with lower volatility and higher liquidity through a portfolio of debt and money market instruments. So it is basically, you can say, similar to cash fund is basically similar to money market instrument. And you can say it is basically related to liquid funds. So liquid funds, you can either call it at cash fund or liquid funds. It is more or less same. Okay, now come to another very important aspect of the mutual fund, which is exchange traded funds. So I will take some time to explain this. What is exchange traded funds? You just go through the slide first, and then we will try to correlate this slide with further explanation and examples also. So basically, exchange traded fund is a hybrid, or you can say a combination of a stock and a mutual fund. Mutual fund is specifically index fund. And these funds are listed on the stock exchange and prices are linked to the underlying index. So ETFs can be bought and sold like stock. It can be bought and sold at any time during the market hours. Okay. Now we'll try to explain this further. Exchange traded funds. So exchange traded funds, you can say, is a combination of stock and index fund. I'm not using mutual fund. I'm specifically stating is an index fund because exchange traded fund is also a passive investment. Why passive? Because it is also the units are directly invested into those companies which are there in the index. For example, there's a Nifty 50 ETF. So Nifty 50 ETF, you can understand that ETF is investing in those companies which are already there in the Nifty 50. So it is a combination of stock and index fund. Now, how index fund? Because it is passive and invest in a basket of securities, invest in a basket of securities which are which are there in the index. Means whatever shares are there in the index, for example, Nifty 50, ETF invested into it. This is an example. Now, how it is a स्टॉक के फीचर ETF में स्टॉक के फीचर्स कैसे हुए? It is listed and can be sold and purchased at any time during trading hours. During trading hours. This point, trading hours is important. Means it can be investment can be taken place at any time between 9:15 a.m. when the market opens and 3:30 p.m. when the market closes. So it can be traded just like stocks. So whenever a ETF is issued, it is listed in the stock exchange and you can sell and purchase it at any time during trading hours. And in case of, but index funds, it is somewhat different because index fund is basically you can say a mutual fund. So investment, it can be purchased and sold anytime, but it cannot be sold anytime during the day. So it can be through the mutual fund manager only. So that is the basic difference between an exchange fund and an ETF. I will take some time to explain the difference between these two so that it is more clear that what is the difference between ETF and index funds. These are both passive funds. ETF is, you can say, combination of, you can say, stock and index fund. And index fund is a mutual fund. So what is the difference between these two, ETF and index fund? Let us see. Index fund and exchange traded fund, that is ETF. Now, index fund is basically passive. Why passive? Because the mutual fund investor do not have to actively participate in it. It simply invest in those shares which are there in the index, for example, Nifty 50. ETF is also passive. Index is passive, open-ended mutual fund. It is basically a mutual fund. And ETF is passive and listed in stock exchange. Okay. Index fund is not listed because it is a open-ended fund. Now, second point, what is the difference? It is again open-ended open-ended, or you can say it is not listed, and it can be, ETF can be sold and purchased anytime during trading hours. Okay. I think first two points are clear to you. Index fund passive, open-ended mutual fund. ETFs are passive and listed in the stock exchange. It is open-ended and ETFs are can be sold and purchased anytime during trading hours. Now, there is no liquidity issue. No liquidity issue in case of index fund. No liquidity issue means it can be you can exit from the fund at any time. You can sold your index fund at any time, and you can get out of the fund. But there are liquidity issues in case of ETF. It is noticed that there are liquidity issues. The reason is that, in spite of the fact that exchange traded funds are listed in the stock exchange, and you can trading is going on between the in the ETFs, and you can sell and purchase anytime during the market hours, that is between 9:15 a.m. to 3:30 p.m., right? But ETFs are not frequently traded. Some ETFs are not frequently traded. It is sometimes difficult to get out. In you one investor may not find any seller for the if he wants to sell his you can say ETFs. So ETFs sometimes face liquidity problems, and the investor are generally faces problems in selling the ETFs in the market. Another is point which differentiate between index fund and ETF is more expense ratio, or I will term is a higher expense ratio. You can say higher expense ratio in comparison to ETF. Index fund expense ratio is lower in comparison to active funds. ETFs lower expense ratio. So in ETF, the expense ratio is lower because it is basically mutual fund managers do not have to do anything much. They have to simply invest in those securities that they are in the Nifty, and trading is already going on. So frequent participation of the mutual funds are not required. But somewhat participation of the mutual fund manager is required in case of index fund, because they have to constantly monitor that what whichever shares are there in the Nifty or not. If any share is not there, then what to do after that. And since it is a mutual fund, then continuous management is also required. So some amount of expense ratio is there in case of index fund. In ETF, there is expense ratio, but expense ratio is very, you can say minuscule or very low in comparison to index fund. Another point which differentiate between index fund and ETF is the valuation. So index fund valuation is done at the end of the day. At the end of the day. And in this case, in ETF, there is continuous valuation. There is continuous valuation because it can be traded just like stocks. So there is continuous change as the stock prices changes continuously. Therefore, the value of ETF changes continuously. But valuation is done only at the end of the day. At the end of the day, NAV is calculated, and then the valuation is done. So you can say ETF is more, you can say, linked to market. And next point which differentiate between these two is another important point. In index fund, no demat account is required, because in mutual fund investment, demat account is not compulsory. So no demat account is required in case of index fund. But in case of index fund, since it is traded in the stock exchange, the demat account is required. And last but not the least, can index fund, you can invest in the invest fund through SIP, which is also called as systematic investment plan. So in systematic investment plan, investor basically invest a small amount, you can say every month. He can start with as small as 500 rupees. And another, you can say, option is to invest in lump sum, but in SIP, a periodic amount is invested every month. So that is why it is called systematic investment plan or SIP. So in index funds, the investment can takes place through SIP, but there is no SIP in case of in case of ETFs, because there is no SIP because it works more like a stock. Since it is traded in the stock exchange, there is no SIP in case of ETFs, exchange traded funds. So I hope it is clear to you. Index fund, ETF, it is both are passive, but index fund is open-ended mutual fund and therefore not listed. And advantage of the index fund, since it is open-ended, one can buy and sell anytime, but can exit from the scheme at any time. In ETF, one can also exit at any time because it can be sold and purchased just like shares during trading hours. But the liquidity is the problem sometimes in case of ETF, because it is not frequently traded in the stock exchange. So sometimes the investor find it difficult to sell the ETFs in the stock exchanges. The expense ratio is comparatively lower in case of ETFs because mutual fund managers do not have to do anything much, since it is continuously traded in the stock exchange. It is the valuation is continuously done automatically. So mutual fund managers do not have to do anything much. So expense ratio is very low. Expense ratio is higher in comparison to ETF in case of index fund because the mutual fund manager still have to manage the fund. So there is management expense. So some amount of expense ratio is there in index fund. And as you know, the expense ratio index fund is very low in comparison to the active funds. Now, very another important aspect is valuation. Valuation is done at the end of the day because of index fund, because it is not traded in the stock exchange. So valuation is done, value is done, or NAV is calculated at the end of the day. But in case of ETF, the valuation is continuous. Continuous valuation is done because it is continuously traded in the stock exchange, just like stocks. So there is continuous valuation in case of ETF. Again, no demat account is required in order to, you can say, invest it in an index funds because it works more like a mutual fund. And in ETF, the demat account is required because it is trading. It is traded just like the stocks. Again, last but not the least, in index fund, investment can be taken place through SIP, that is in systematic investment plan. But there is no SIP in case of exchange traded fund because of the same reason that it is works more like a stock. So this is the basic difference between index fund and ETFs. So I hope this concept of ETF is clear to you now. Now come to fixed maturity plans. Fixed maturity plans are closely ended mutual fund in which an investor can invest during a new fund offer. So new fund offer, you know that this is basically new fund offer is a IPO, or initial public offer of you can say companies which are coming out with some new issue of shares. So in case of mutual fund, the term used is new fund offer or NFO. So FMPs, that is fixed maturity plans, basically invest in certificate of deposits, commercial papers, money market instruments, and non-convertible debentures over fixed investment period. So fixed maturity plans are basically related to, you can say, money market mutual funds and debt funds. And sometimes they also invest in bank fixed deposit also. So these are what fixed maturity plans are. Yes, Suraj, if we hold the investment in mutual funds over a long period of time, we can get the dividend because it depends upon what the plan is. If it is a dividend oriented plan, then dividend is continuously given to the investors. If a particular is not a dividend oriented plan, growth plan, then we can, as an investor, get the benefit of the higher value in case of future. For example, it will be higher value will be depicted in the NAV. So at a later stage, an investor can invest and pocket a good profit if the value increases or the NAV increases in future. So yes, the investor can hold the mutual funds over a long period of time. Now come to the various advantages of the mutual fund. First advantage is the professional management. The mutual fund managers are professionals in their field, and because of that, the investor who do not have the time to research and analyze on his own that which companies to invest, which shares to invest, whether the investment should be in large cap, mid cap, small cap, all these issues, they do not have to, you can say, pay attention to. So they can simply invest in a mutual fund and leave it to the mutual fund managers who are professionals in this, in their field. Second is diversification. The mutual fund depends upon diversification. In some funds, diversification is less. In some funds, diversification is high. As we have seen that highly diversified companies, the mutual fund generally invest 40, 50, 60, 70 companies. In case of at least investment is 50, at least they invest in the shares of, if it is an equity fund, then at least 50 to 15, 20 companies. So diversification is there in mutual funds. So it is considered to be safer since because of high diversification. Convenient administration, it is linked to the first point that mutual fund managers are expert in their field and they can conveniently manage the mutual fund. As an investor, we do not have to worry about anything. We simply invest the money in a particular mutual fund and they will take care of everything. So day-to-day management and administration is a part of the headache of the mutual fund managers. Mutual funds generally give a high return. It is on an average, they are give 10 to 12% return. On an average, I would say some are getting uh, higher returns of more than 12%. Some are getting, mutual funds are getting less returns also. But on an average, they give a higher return in comparison to if one invested in a bond or debt, excuse me, or in case of fixed deposits. So return is higher in comparison to debt funds or you can say fixed deposits. Low cost of management. Cost of management is low because highest expense ratio is 2.5% one can give. And generally in case of index, if you one is invest fund, it is at as low as 1% in case of index fund and even less than that. So cost of management is low. Liquidity is there, especially if it is a open-ended fund. Another advantage is in case of transparency. Transparency and highly regulated. So these two are basically interrelated. Mutual fund is basically regulated by SEBI, which is the market regulator, Securities Exchange Board of India. And that is why it is transparency is there because SEBI is constantly, you can say, changing its rules and regulations to make the mutual fund more investor friendly. And all the information have to be disclosed by the mutual funds promptly at his website also, and in the case of AMFI also. AMFI, I have said, Association of Mutual Fund, basically, which is a facilitator. So any information regarding open-ended funds, facilitator, one second, please. So AMFI is basically the facilitator, and all the information regarding NAV, expense ratio, close-ended mutual funds, open-ended mutual funds, all these informations are given in the NV and they're continuously updating the NAV also, net asset value. So transparency is there in the mutual fund because it is regulated by SEBI, facilitated by MFI, and every information is there in the website of the mutual fund companies also in the website of the MFI. Economies of scale. Since the mutual funds generate such high amount of money, pooled money from the investors for thousands and lakhs of rupees, I think crores of rupees, thousands of lakhs of rupees. That is why they will able to work on economies of scale. Means by increasing the scale, they can reduce their cost. Flexibility is there. Means, especially in case of open-ended funds, because they can open-ended funds, as we have seen, that they can get out of the funds as soon as they find it convenient. Closed-ended fund, there is a maturity period, but there is flexibility in the case of the open-ended funds. Convenience, also convenience, because they can invest it at the convenience of the home. They do not, and they can save on their, you can say, research and analysis. Yes, Kirti, the investment in mutual fund does not require a demat account. So demat account is not compulsory in case of if you invest in a mutual fund. If you want to invest in a exchange traded fund, ETF, then a demat account is required. Now, there are some of the drawbacks or disadvantages in case of a mutual fund. There is no guarantee of return because it is said that mutual funds, if you heard the advertisement also, that mutual funds are subject to market risk, read the offer documents carefully. So there is no guarantee of return, especially in case of equity fund, because the markets may come down and the returns may be lesser. Another drawback is a diversified portfolio does not maximize return. As we have seen that high diversification does not necessarily increase profit. Because if the mutual fund invests in a 40, 50, 60 companies, some of the companies may be generating a higher return, some of the companies may be generating a lower return. So you can say too much diversification actually, you can say, lessen the total return. Then another drawback is that selection of proper funds only on the basis of past performance. In mutual fund, the selection can be only on the basis of the past performance only. Because as in case of shares, as we've seen in fundamental analysis, there is no EIC analysis. In case of mutual fund, that is, there is no economic, industry, and company analysis in case of mutual funds. We have to depend on whatever data is provided by the mutual fund for the last 5, 7, 10 years. So you can say uh, data is limited in comparison to the stocks. Another is the cost factor. Mutual funds man not only charge their expense ratio. If one invests through the distributors, there is trail commission. We have seen. And there are, you can say, entry and exit load. Entry load means if one is entering into a particular fund, then certain expenses are charged, which is called as entry load. And there is exit load also, because it means that if a particular investor in exit from the mutual fund before a particular period, then mutual fund charges certain expenses, which is called the exit load. So there are various costs, not only expense ratio, but trail commission also. If one to invest through the distributor, then there is entry load. If one is making an entry into the mutual fund, entry charges are levied. Then if one is exiting from a particular mutual fund, then exit charges are levied. So these are some of the advantages and disadvantages of a mutual fund. Now come to some of the terms associated with the mutual funds. One term which is very extensively used in case of the net asset value is uh, one of the most important terms used in the mutual fund is the net asset value. Net asset value basically is assets. I will take some time to explain this. Net asset value. is calculated as net as total assets minus total liabilities upon number of outstanding units. So if you remember during my first example that mutual fund has collected money from the various investors and invest into various schemes. And for that, there is a cost for the investor. So NAV is basically a cost. If I want to invest in a particular mutual fund, I have to invest it at a particular NAV. So I have to pay that price. But the existing investors can sold the units at that price. It's very similar in case of share prices also, because if a new investor has to invest, he can only purchase at the current market price. But an existing investor, if he thinks that the market price is higher, he can sell at that price. So NAV is actually changes from day to day. If I go to a particular website, the MP, here the NAV is given. See, direct plan and regular plan. If you see, I hope this website is in front of you. You're able to see this. Axis Blue Chip Fund. And latest NAV, if you see that one point I also want to highlight is this latest NAV in case of regular plan, direct plan. If you see that the NAV in case of the direct plan is higher because of the lower expense ratio. And 5-year return, 5-year return is given, and this is also the return. So return in case of is varied. NAV is also, you can say, fluctuate from on a day-to-day basis. So if you see this tomorrow, this will be a different NAV. So NAV changes from day-to-day basis, just like the can say shares. So if one wants to invest in Axis Blue Chip Fund, if I want to invest in Axis Blue Chip Fund on today itself, that is 21st of February 2024, then I have to, if I opt for a regular plan, I have to invest it at this 52.60. And if I opt for a direct plan, I have to invest it at 59.75. Okay. So this is net asset value per unit. So just read the slide carefully. Net asset value, it is the value of net asset of the fund. The investor subscription is treated as the unit capital in the balance sheet of the fund, and the investment on their behalf are treated as assets. So whatever investment are made by the mutual fund are their assets. So net asset value, the net asset will be asset minus liabilities. So net asset value per unit is equal to net assets of the scheme, that is total assets minus total liabilities divided by the number of outstanding units. And net assets of the scheme is equal to, is given in front of you, market value investment plus receivables, other accrued incomes, other asset, accrued expenses, and minus any accrued liabilities, that is other payables and other liabilities. And we will take more questions or practical questions on NAV also. So on this, the concept of NAV will be more clear to you. Now, there are certain terms associated with mutual fund, that is entry and exit load. I have just discussed that entry load means if any unit investor purchases the mutual fund, then certain entry charges are levied. And if a particular investor is opting out of the scheme, then before the particular period, then exit load or exit charges are levied. Now, entry load is actually removed by the SEBI. There is no entry charges by the mutual fund managers, but exit load sometimes charges. If, for example, a particular investor is going out of the scheme before a particular period, then exit load or exit charges is levied in addition to the expense ratios. An exit load is basically deducted from the NAV at the time of redemption. Now, trail commission, I have also been discussed that it is basically applicable in case of regular plans. Means when an investor investing in a particular mutual fund through the distributor, then the mutual fund manager has to pay certain commission to the distributor. That is what trail commission is. So, since trail commission is added to the expenses, that is why the expenses are high and the net asset value is less in case of the regular plan, as we have seen in the MP website also that the in case of direct plan the NAV is higher, in case of regular plan the NAV is lower. And this is a very important term used in that is the expense ratio. So it is the percentage of the assets that were spent to run a mutual fund. So what covered in expense ratio? That is basically the expense ratio or management advisory fee on the part of the mutual fund. Travel cost, consultancy fees, these are all part of the expense ratio. Expense ratio, whatever expenses are part of the total asset. That is what expense ratio is. But expense ratio does not include brokerage cost for trading the portfolio, and it is also referred to as the management expense ratio. Now, I will discuss some of the important terms associated with the mutual fund. First is side pocketing. I will take some time to explain this concept, side pocketing. So, what is side pocketing? Side pocketing, as the terms indicate, that side pocket. It means the risky illiquid assets are, you can say, transferred to a separate side pocket. So, in side pocketing, illiquid and risky assets are transferred to a separate side pocket. So I will just segregate between two side pocket and a fund which is liquid. In side pocket, there is a separate NAV. And which is liquid has a separate NAV. So why this is done? Why this is side pocketing is done? The purpose of side pocketing is to actually benefit the retail investors. Sometimes what happens, the mutual fund manager invests in a particular fund and the fund is not able to, particular company is not able to give its return back. Let us take an example that say these are various investors. Okay, these are various investors. They invest in a mutual fund. They invest in a particular mutual fund. Mutual fund invested in a particular company. Say in a particular company. But that company failed to pay the amount. That company failed to pay. Since that particular company failed to pay to the mutual fund is not able to pay to the investors. mutual fund is not able to pay to the investors. So in this case, certain portion means, for example, it has invested in ABC mutual, ABC company, ABC Limited. So whatever funds are, you can say, locked in ABC, the returns are, the amount has not been able to transferred by the mutual fund to the investors. So that amount can be invested in a separate, you can say, side pocket. And there is a separate NAV, that is a illiquid fund. But a fund which is, so this ABC is excluded in this, which is liquid. So mutual fund, illiquid portion in a separate side pocket. Actually, it is also benefit to the retail investors also, because what happens is that the big investors, whenever the fund defaults, for example, ABC defaults, ABC not able to pay, ABC defaults. So the big investor, the institutional investors will actually pressurize this mutual fund to actually pay their amount as early as the possible. So when the amount is paid to this institutional investors, less amount will be in the hands of the mutual fund. So retail investors will suffer in this case. To actually benefit the retail investor, it is the illiquid funds, means the amount which had not been received from any other mutual fund which had invested. For example, ABC in this particular example. So that amount of money is kept in a separate pocket and NAV is separately calculated whenever that amount is received from ABC. For example, certain amount has been received from ABC. Certain amount is received from ABC. Then this amount will be paid back to the investors. Then that this amount will be paid to the investors. So up to that time, until which the ABC pays the money, it will be kept in a separate side pocket. Does the investors give any information regarding the? Yes, the investors given a time, they have to be separately, mutual fund has to be separately disclosed to the mutual fund investors that certain default has taken place. They are kept the amount in a separate side pocket. If you are want to willing to go ahead with this, please tell. So certain time period, time frame is given up to which the investors have to decide that whether they want to get out of the funds or whether they want to remain in the side pocket. So there are two options. If the investor wants to remain in the side pocket, then they have to wait until the other defaulted company pays back. For example, in ABC, whenever the ABC company pays after 1 year. So whenever the ABC company pays, the mutual fund returns the amount. Up to that, one has to be patient in the and remain in the side pocket fund. But if the investor wants to know, I want to get out of the funds, he can get out of the funds, get whatever amount he has invested. In this case, generally the mutual fund manager charges certain exit load. Certain exit charges are charged by the investor. So there is a two point of view. One can get out of the funds, take his money by paying some exit charges, or one can remain in the side pocket and be patient until the amount is received or from the defaulted companies and paid by the mutual fund. So this is what the purpose of side pocketing is. Now come to another important concept of this mutual fund, which is tracking error. So tracking error is basically divergence or deviation of a fund's return from the benchmark it is following. Just go through this slide and I will explain it also. So it is basically, you can say tracking error is basically associated with the passive fund, that is index fund. It's related to the index funds. So I will take some time to explain this tracking error. Before tracking error, there's another term which is important, that is tracking difference. Tracking difference. What this is? Tracking difference means difference in the return of the difference in return of mutual fund, return of index fund, and the benchmark. And the benchmark. Benchmark is the index. For example, Nifty 50. For example, Nifty 50 in this case. So let us say Nifty 50 is generating a return of 12%, and index fund is generating a return of 11%. So tracking difference or TD in this case is 1%. Okay, so this is basically a difference between the return generated by the Nifty 50 generating a return of say 12%, and the index fund is generating a return of 11%. So this 1% difference is basically the tracking difference. So why this difference occurs? This is difference. The main point is actually the expense ratio, because there are certain expenses the mutual fund has to incur while managing the mutual fund, because they have to spend heavily on research and development expenses, consultancy expenses, travel costs. So these expenses have to be deducted by the mutual fund manager before giving the return to the investor. That is why the return in case of index funds are lower in comparison to the benchmark, that is index and Nifty 50 in this case. There may be any other indexes also. So that is what tracking differences in is. And what about tracking error? What is tracking error? Tracking error is basically the, we can say, standard deviation of, in simple language, standard deviation of tracking difference. Let us say for first year, the difference is 1% as we have calculated. The second year, the difference is 0.75. The third year, the difference is say 1.25. Tracking difference. So, what is the deviation? What is the deviation? Then standard deviation calculated in order to calculate the tracking error. So tracking error is calculated by this simple formula is given in your study material also. Tracking error is equal to, I am simplifying the language, formula is same. That is return of portfolio minus return of benchmark return of portfolio minus return of benchmark divided by n minus 1. N means the number of years we are taking. So basically in this example, if we are taking that, yes, the first year the difference was index was giving a return of 12% and this benchmark is giving a return of index fund is given a return of 11%. So by this way it will be calculated. And then the difference is second year, the difference is, you can say, and third year, the difference is say number of years is 3. So it will be 3 minus 1. In this way, the tracking error is basically calculated. So it is basically the standard deviation or divergence of the tracking differences, how much divergence is taking place. So simply speaking, tracking difference is basically the difference in the return of index funds and the difference in the return of the benchmark. As in the example, for example, Nifty is giving a return of 12%. And if the index fund is giving a return of 11%, then 1% is the tracking difference. Tracking error is nothing but actually the standard deviation, or it calculates the divergence between the differences between this benchmark and the index fund for a number of years. So by this formula, if for data of 3 years is taken, then differences between this 12 minus 11 I have taken, for example, 12 is the difference return of the Nifty and 11 is the return of a particular index fund. Then difference is taken for the first year, then difference for second year, difference for third year. And for this figure, the standard deviation is taken. That will be the tracking error. And as I said, the main, you can say, the reason for this tracking error is the expense ratio, because by deducting the expenses, the return is given to the shareholder. That is why there is difference between whatever return is generated by the index fund and whatever return is there in the benchmark, that is the index. So students, this is all for the mutual fund lecture. You can also contact us at this number. 0120-3045-956, or you can also download the mobile app and you can contact us for the further queries. So thank you so much. Thank you for this patient listening. And Ashish sir is there to summarize the session.
Welcome students. Thanks a lot for your interest in the lecture. As I've seen, a lot of queries are there. Now, one query from Marsha sir: at final level, ICAI expect expert knowledge from us. Expert knowledge can be gained from exploring, but time is limited factor than how to prepare myself for examiner. Mansha, better please see, and it is for all students. Of course, we expect expert knowledge. However, the framework, or you can say the limit, is our syllabus. See, we can provide you our expert knowledge only on the part of application. That can be changed with the time to time. Now, suppose today there are some guidelines. Tomorrow the guidelines can be revised. So accordingly, we provide the basic how we have to act. Okay, it may be regarding the regulatory requirement or other requirements that can be kept on changing. Like if we talk about, like in our previous foreign exchange lectures, we were saying that we have to hedging. Okay, we have to learn how to hedge. Now, how the documentation, how the formalities, these are other parts. These keep on changing. So we cannot say you should be well versed with the documentation on or formalities part. Your role is only to how to hedge. You have to draft a basic strategy. How to execute, it is basically a procedural part. So you have to develop your understanding only for the application of the concepts. So my request to you, don't limit your exploration of the knowledge within the preview of the syllabus. Of course, one session I can provide you for gaining more expert knowledge, that is to refer one financial newspaper on daily basis. Actually, it will keep you connected with the world, what is going in the world or what is going in the financial world. So my request to you, please refer at least one newspaper. It can be Mint, it can be it can be Economic Times, it can be Business Line, it can be Financial Express. As per your own choice, there is, because everyone has their own taste. We cannot say that only one paper is there. Business Standard, there are 5 newspapers are approximate are there in the market. So you can refer any one of them. Okay, student, with this, we come to the end of this lecture. We shall continue this discussion in next class also.
Yes, sir. Yeah. Next week.
Okay, student. See you in the next class. Meanwhile, if you have any query, you can contact at this phone number, or you can send your queries through mobile app. Okay, student. Thank you. And thank you, Vivek sir, for sparing your precious time and throwing the light on this, enlightening the student on this very interesting topic. So thanks a lot, sir. Okay, student. Thanks a lot.
Thank you, sir. Thank you so much.
Okay, sir. Have a nice time.